What surprised me, Ben, has been the increased pace of softening in Asia as the years progressed. There are geographical variations and other nuances that mean that not all areas are softening at the same rate. For example, where a client has a US casualty exposure, that they're an outlier and they're likely to still experience some upward pressure on rate. But for in-scope occupancies and where a client can differentiate themselves through their risk profile, competition can be intense.
Welcome to Global Marketplace Insights by Willis, a WTW business, a podcast series showing the latest trends from the specialty and regional insurance markets.
Hello and welcome back to the Marketplace Insights podcast series, where we're discussing the current state of the Asian market for Q4. I'm Ben Dunston, the placement leader for Asia, and I'm delighted to be joined here today by Paul Ward.
Good afternoon, Ben. Delighted to join you today.
Good afternoon. Let's dive into the state of the market through the context of three client questions which we've had come in, Paul, if that's all right. The first one coming up is, what are the current and forecasted rate trends for Asia? Well, I think I'll take this first, then maybe pass it on to you. I think we can talk immediately about the rate environment, for which non-loss impacted and non-Nat Cat exposed risks, we're seeing a transitioning market with around 7.5% to 15% reductions for a wide range of products: property, marine cargo, casualty, energy, and financial lines risks. I'd say sometimes larger rate reductions if that risk's well managed and in appetite for a large number of insurers. But it's probably important to mention to the listeners, of course, that rate pressures up or down are extremely multifactorial, and they're dependent on profitability, industry, capacity. And those markets in Asia, for instance, that have tariffs, they wouldn't be subject to the same pressures at all. Asia's so diverse as an insurance market, and each market really is at a different stage of maturity. They're driven by their own influences surrounding reinsurance, government policy, and of course, the insurance's traditional role within the economy. Paul, what have you noticed for property and casualty?
What surprised me, Ben, has been the increased pace of softening in Asia as the years progressed. There are geographical variations and other nuances that mean that not all areas are softening at the same rate. For example, where a client has a US casualty exposure, that they're an outlier and they're likely to still experience some upward pressure on rate. But for in-scope occupancies and where a client can differentiate themselves through their risk profile, competition can be intense. In both property and casualty, double-digit rate reductions are not uncommon, and where premium volumes are significant and the capacity deployed is more limited, reductions can be really substantial. Additionally, if a client experienced significant increases when the market was harder and they're prepared to entertain substantial remarketing, I think this can bring even further benefits to the table.
Touching on the subject of natural catastrophe, we know that the new normal is somewhere between $120 and $150 billion worldwide, and that's reported by quite a lot of industry sources. Asia's obviously prone to those events. You had the earthquake in Thailand, you had Myanmar, we have regular typhoons in Hong Kong and China as well. Do you see any rate pressures or market impact around natural catastrophe in Asia?
Yeah, Asia is very exposed to natural catastrophe, both the traditional typhoons, earthquakes and flooding, and increasingly the secondary perils like the landslip and the storm surge. Nat Cat is still one of the main drivers of insurers' reinsurance treaties, their capital allocation and ultimately their pricing. So in geographies with a heavy cat footprint, underwriters are a bit more cautious in the capacity they deploy and on the pricing, although I think rate reductions are still being achieved. What I would say is it's a great time for clients to deploy the latest risk modelling techniques to ensure they're taking a data-driven approach to the amount of risk they transfer and maximising their premium spend.
And then the second question coming in, What developments can Asian clients expect in how insurers allocate capacity and coverage offerings on their risks? So I'll take this first and then maybe pass to you. What I would say is capacity remains plentiful in the Asian market, and the wholesale Singapore-based markets are trying to hit growth plans made in 2024 for almost all lines and in a softening rate environment. This, coupled with acquisitional markets in London plus new MGA capacity, will cause softening pressure in Q4 2025. One example about capacity that we could give is looking at the coal and the thermal power capacity in 2025. This has grown by around 30% in the last 18 months. And insurers have loosened some of the rules around ESG. But most importantly, that there has to be a transition story for that client or that insured. Also around the capacity and how that is now being deployed, which I think actually is a industry-wide change, is the use of auto-follow facilities. Now, these are expanding presence in the Asia market, they're in the London market, and they're different from traditional facilities in they cover a wide range of products in both long tail and short tail. Willis launched Gemini, of course, in Q4 this year. It has 12.5% capacity and offers 2.5% off of the lead market pricing. So I think we're going to see more facilities in 2025. The direction of travel definitely points towards portfolio underwriting, which is good for clients, as it allocates them a slug of capacity on their risks. However, often these facilities have what I would call to be unengaged capacity, which for major clients means they're not actively looking to support you in sort of risk transfer or partnership type areas. So there's a decision to be made there. The coverage question is interesting. Do you think the coverage position has moved much in 2025? Do you see anything notable in property and casualty?
Well, clearly, the first reaction in the challenging economic environment is that the soft market's a phenomenal opportunity for clients to save money, especially for those who did experiencing increases in the last few years. But I think it's also a great opportunity to look at limits purchased and coverage. Now's a good time to assess if both of those areas are fit for purpose. So I think what that could mean is revisiting sub-limits of coverage. Often those have been inflated downwards in recent years, and perhaps it's a good time to bring them up to date. You could also look at redeploying some of the savings by increasing cat limits, or maybe even on different coverages where you've got exclusions on your property and casualty. That could include cyber, terrorism, political violence, for example. The standard exclusions remain: the typical cyber communicable disease, the focus on non-damage BI, the territorial exclusions in respect of Russia, Ukraine and Belarus. And on casualty, of course, we're seeing the introduction of PFA exclusions pretty widely.
Yeah. And then the third question what strategic advice should Asian clients consider for upcoming placements? Paul, have you got any thoughts on that?
Yeah, first of all, I always think it's best to start early, engage markets at least 90 days, if possible, before renewals to secure capacity and ensure you have time to move through your internal stakeholder processes, especially if you've got a complex multi-territory program and you've got territories that are cash before cover, such as Japan and India, in your asset base. Secondly, I think tell your story. In that 90-day period, it's a great opportunity to highlight risk improvements, get your risk management measures down and communicated to the market, what you're doing about loss prevention and your future plans as well in this area. Any future CapEx will also be of interest to the market. Everybody will like to hear about your potential future growth, and this will help your broker to represent you in the market and set you apart from other peer group clients who are looking for capacity.
Yeah, and if I was going to add, I suppose, two extra dimensions to it in addition to what you've suggested, I mean, my first point would be explore different capacity bases. We talked earlier about how the market's very dynamic, it moves at different speeds around the world. So you should consider regional and specialty markets to check what's available in today's conditions. Your broker should be able to advise you if there's capacity available in, say, a hub such as London that can be more competitive. The fourth thing, and adding on to what you've said, is usually, I'd say, use risk and analytics to quantify and qualify what your limit strategy should be. Leveraging those to support the underwriting submissions, it is critical in setting you apart. Really having a rationale, having a strategy is important, and not simply peer benchmarking. Okay, the last question that's come in is an interesting one, and we get this quite a lot. And so I'll just pass to you, Paul. But strategically, is there any time of year that is better than another to enter the market for your renewal?
Yeah, that's an interesting question. Across the region as a whole, renewal dates tend to be pretty widely spread these days, although there's clusters of renewals in certain territories around timings like 1/4 or 1/7. I don't really see a dramatic difference in terms of client outcomes. My personal opinion is that there could be something to be said for not renewing at the same time as other clients in order to bring more focus from underwriters on your business. For clients with a heavy typhoon exposure, they may give some thought to the timing of the renewal outside of the peak typhoon season. That just helps them really to avoid potential loss impact while they're in the middle of a renewal.
Thanks, Paul. Appreciate it. And that is the end of the questions. So just a brief recap of what we've covered off here today. We've covered off in the first question, the question was asked about what the current and forecasted rate trends were for Asia. The second question, what developments can clients expect in how insurers allocate capacity and coverage? And then lastly, the advice really for clients to enter the market, including, of course, the timing as well. So that wraps up for Q3. Thank you, Paul, for your contribution to this episode of the Marketplace Insights podcast. And to all the listeners, we'll see or hear you in the next one.
Oh, thanks for inviting me today. It was a pleasure to join you, Ben. Thank you.
Thank you for joining this WTW podcast, featuring our latest global market commentary. WTW offers insurance-related services through its appropriately licensed and authorised companies in each country in which WTW operates. For further authorisation and regulatory details about our WTW legal entities operating in your country, please refer to our WTW website. It is a regulatory requirement for us to consider our local licensing requirements. The information given in this podcast is believed to be accurate at the time of publication. This information may have subsequently changed or have been superseded and should not be relied upon to be accurate or suitable after this date. This podcast offers a general overview of its subject matter. It does not necessarily address every aspect of its subject or every product available in the market, and we disclaim all liability to the fullest extent permitted by law. It is not intended to be and should not be used to replace specific advice relating to individual situations, and we do not offer, and this should not be seen as legal, accounting or tax advice. If you do intend to take any action or make any decision on the basis of the content of this podcast, you should first seek specific advice from an appropriate professional. Some of the information in this podcast may be compiled from third-party sources we consider to be reliable. However, we do not guarantee and are not responsible for the accuracy of such. The views expressed are not necessarily those of WTW. Copyright WTW 2025, all rights reserved.